Derek is 34, lives in Ohio, works in software, hates his commute, hates his manager, but 6 years of saving got him somewhere. He's got $100,000 sitting in a brokerage account, and one night, scrolling through YouTube at 1 a.m., he discovers something. Monthly dividend stocks. Stocks that don't pay you once every 3 months like most companies. These pay you every single month, like a second paycheck, like rent in reverse. So Derek starts searching, and he finds one stock yielding 24%. He runs the math. $100,000 times 24%, that's $24,000 a year. Divided by 12, that's $2,000 a month. His rent covered by one stock. His finger is on the buy button. He's one click away from what he thinks is financial freedom. Then he looks at the chart, and that chart saved him a third of his money. By the end of this video, you'll see 5 monthly dividend stocks, ranked from safest to riskiest. Each one pays you every month, and you'll learn how to spot the difference between a stock that builds your income and one that quietly eats your savings while pretending to pay you. One of these 5 stocks looks like it covers your entire rent. The math says it'll destroy a third of your capital instead. I'll show you the exact numbers that prove it. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Before I show you the first stock, I need you to understand one number, just one. It'll change how you look at every dividend stock for the rest of your life. Yield equals annual dividend divided by share price. That's it, a simple fraction, 2 numbers. But here's where most people get tricked. There are 2 ways that yield number goes up. The good way, the company raises its dividend. It's paying you more because the business is growing. The bad way, the stock price falls. The dividend stays the same or even shrinks, but the price drops faster, so the yield looks higher. Not because anything got better, because the stock got cheaper. Same number on your screen, completely different story underneath. For every stock I'm about to show you, I want you to ask one question. Did the yield go up because the company got better or because the stock got cheaper? Keep that question in your head, because by stock number 5, the answer will save you real money. Let's start at the bottom of the ladder, the safest monthly dividend stock in America. Stock number 1, Realty Income, the anchor. This company actually trademarked the name the Monthly Dividend Company. That's how long they've been doing this. Realty Income is a REIT. That stands for Real Estate Investment Trust. Sounds complicated. It's not. It's a company that owns buildings, lots of them, over 15,500 commercial properties across the country. Walgreens, Dollar General, FedEx warehouses, gas stations. When those businesses pay rent to Realty Income takes a slice and pays it to you every month, like clockwork. And here's the part that matters. Realty Income has paid 670 consecutive monthly dividends. That's over 55 years of monthly payments without missing one. They've raised their dividend for 31 straight years, through 2008, through 2020, through every rate hike and market panic in between. So what does $100,000 in Realty Income actually pay you? The yield right now is about 5.1%. That gives you roughly $5,100 a year, which comes out to about $425 a month. Now, $425 isn't paying anyone's full rent. If you're in a city where rent is $2,000 a month, Realty Income covers about 21%, a little over a fifth. But here's something most dividend videos won't tell you. A high-yield savings account right now pays about 4.1%. That's $342 a month on the same $100,000. Completely risk-free, FDIC insured, your money can't go down. Realty Income beats that by $83 a month. That gap is the price of stock market risk. Whether that's worth it depends on one thing: dividend growth over time. Realty Income has raised its payout every year for 3 decades. A savings account has no growth. That's the long game. Realty Income isn't trying to pay your rent today. It's trying to make sure your money doesn't go backward while you build towards something bigger. So the safest monthly stock covers about a fifth of the rent. The next one more than doubles that, and it's never cut its dividend either, but it's a completely different kind of company. Stock number 2, Main Street Capital, the gold standard. Before I show you this stock, you need to understand what a BDC is. There are companies in America that are too small for Wall Street, but they're too big to walk into a regular bank and get a loan. They're stuck in the middle. A BDC, a business development company, is the lender that fills that gap. It borrows money cheap, lends it to those mid-sized businesses at higher rates, keeps the spread, then pays you the difference monthly. Main Street Capital is the gold standard of BDCs, about $4.8 billion in market cap. And here's what sets it apart from almost every competitor. It's internally managed. The people running Main Street are employees of Main Street. Their paychecks depend on the company doing well for shareholders. Their interests are your interests. That sounds simple, but most BDCs don't work this way. Remember that. It matters later. Main Street has never reduced its regular monthly dividend, not once, since its IPO in 2007. It survived 2008, when most BDCs were cutting dividends in half or disappearing entirely. It survived 2020, and when business was good, it didn't just keep paying. It paid extra dividends on top of the regular ones. Its net asset value hit a record $33.46 per share in the first quarter of 2026. This is a business that's getting stronger, not weaker. So what does it pay? The regular yield is about 6.1%. That's $508 a month on $100,000. Include the supplemental dividends, and you're looking at about 7.9%. That's $658 a month. Covers roughly a third of a $2,000 rent. Now apply the filter from Chapter 1. Did the yield go up because the company got better? Yes, the dividend grew, the book value grew, the earnings grew. This is the good kind of yield. Main Street is proof that a BDC can be boring, and boring is exactly what you want when your rent depends on it. Main Street is the gold standard, but there's a smaller BDC paying almost double the income, and its loan portfolio is actually safer. Let me show you why. Stock number 3, Capital Southwest, where income gets real. Same business model as Main Street, same type of lending, but smaller, about $1.4 billion in market cap, roughly a third the size. Also internally managed, also monthly dividend. But here's where it gets interesting. 99% of Capital Southwest's lending portfolio is first lien senior secured debt. Let me translate that. If one of their borrowers goes bankrupt, Capital Southwest gets paid first, before the banks, before the bondholders, before everyone else in line. First in line. That's what first lien means. And 99% of their book is structured this way. That's the highest credit quality of any BDC on this list. They're not accrual rate. The percentage of loans that stopped paying is just 1.1%. Net investment income covers the dividend at about 105%. The payout is fully earned. So what does $100,000 pay you here? The yield is about 11%. That's $11,000 a year, roughly $917 a month, almost half of a $2,000 rent from one stock. Now you're in different territory. This isn't supplemental income. $917 a month is a real number. In cities like Cleveland, Indianapolis, or Tulsa, that's a studio apartment, fully covered. The catches? There are two. First, less diversification. Fewer companies in the portfolio means each bad loan hits harder. 3 defaults at Main Street is a ripple. 3 defaults at Capital Southwest is a wound. Second, less liquidity. Smaller stock, fewer buyers and sellers. When the market panics, this price swings harder, bigger drops, sharper recoveries. The ride is rougher in both directions. But apply the filter. NAV is $16.69. The stock trades at $23.22. That's a 39% premium. The market trusts this company enough to pay well above book value. That tells you something. We just crossed into real income territory, almost half the rent from one stock. Quick question before I show you the next two. Drop a comment right now. What's your monthly rent or mortgage number? I read every single one, and you might be surprised how many people are in the same range as you. So 3 stocks in, we've gone from $425 a month to $917 a month. The next stock crosses $1,100, but this is also where the line between real income and risky income starts to blur, and I need to be honest about that. Stock number 4, Saratoga, the edge of the cliff. Saratoga Investment, $367 million market cap, less than a tenth the size of Main Street. Same BDC lending model, monthly dividend, but two things change everything. The first difference is management. Saratoga is externally managed. That means a separate company, a different firm entirely, gets paid fees to run Saratoga. Here's why that matters. That outside firm makes more money when Saratoga gets bigger, not when shareholders get richer. Bigger, there's a difference. It's a structural conflict of interest. It doesn't always end badly, but the incentive is pointed in the wrong direction. The second difference is coverage. This is the bigger concern. Saratoga earns about 53 to 61 cents per share in net investment income each quarter, but it pays out 75 cents per share in dividends. The payout ratio is somewhere between 113 and 125%. Read that again. Saratoga is paying out more than it earns. The gap is covered by something called spillover income. Think of it like a savings cushion, money earned in past years that hasn't been distributed yet. That cushion is real, but cushions don't refill themselves. What does $100,000 pay? Yield is about 13.5%. That's $13,500 a year, $1,127 a month, covers 56% of rent, more than half. Real money. Now apply the filter one more time. NAV is $24.42. Stock trades at $22.16. That's a 9% discount to book value. Main Street and Capital Southwest both trade at premiums. Investors are willing to pay more than book value for those companies. For Saratoga, the market is saying, we want a discount. Saratoga is the last stock on this list I can defend with a straight face. The income is real today. The business model works today. But the margin for error is thin. One bad quarter and that cushion starts to crack. Here's something I want you to remember. When the payout ratio crosses 100%, you're no longer living off earnings. You're living off savings, and savings have an expiration date. So now you've seen four stocks, $425 to $1,127 a month. The last stock pays even more, a lot more. On paper, it covers your entire rent. But remember that question from the very beginning of this video? Did the yield go up because the company got better or because the stock got cheaper? Stay with me because the answer is the most important lesson in this entire video. Stock number 5, PennantPark. The trap. This is the stock Derek almost bought. PennantPark Investment, another BDC, same kind of lending business, but the yield on this one is different. Depending on which number you use, it's somewhere between 12 and 24%. On $100,000, the higher number gives you $2,075 a month, the entire rent covered by one stock. Except it's not. Let me show you what's actually happening here. 3 layers. Layer 1, the dividend cuts. In 2017, PennantPark cut its quarterly dividend from 28 cents to 18 cents. That's a 36% cut. Gone in one announcement. In 2020, they cut again from 18 cents down to 12 cents. Another 33% gone. This company launched in 2007 at $14.40 per share. Today, it trades around $3.86. That's a 73% collapse in share price over 18 years. Layer 2, the math underneath. Last quarter, PennantPark earned 14 cents per share. It paid out 24 cents per share. It is paying out 71% more than it earns. The difference comes from spillover income, old money, not new earnings. And the book value? It dropped from $7 to $6.73 in a single quarter. The stock price at $3.86 is sitting at a 43% discount to that already falling book value. Let that sink in. The company's own assets are shrinking. The market values it at less than half of those shrinking assets, and the dividend exceeds earnings by a wide margin. Layer 3. What happens to Derek's money over time? Year 1, Derek invests $100,000, collects about $12,400 in base dividends. Feels great, but the stock price falls 5 to 6%, tracking its historical trend. His $100,000 is now worth $94,000. Year 5, his account is somewhere around $70,000 to $75,000, and the dividend has likely been cut again, because that's what PennantPark does. Year 10, that $100,000 could be worth $50,000 or less, and the monthly income he was counting on for rent, it shrank with every cut, smaller and smaller, while his savings melted underneath it. Derek didn't get a 24% return. He got his own money handed back to him in smaller and smaller pieces. Here's the myth. The highest yield means the most income. Here's the truth. The highest sustainable yield means the most income. An unsustainable yield is just your own capital disguised as a paycheck. Now, apply the filter from Chapter 1 one final time. Did PennantPark's yield go up because the company got better? No. The stock collapsed from $14.40 to $3.86. The dividend was cut twice. The yield went up because the price went down. That's not income. That's a warning sign dressed up as a paycheck. A high yield isn't a gift. Sometimes it's a goodbye to your own money. So now you've seen all 5. The safest pays $425, the trap promises $2,000 but delivers destruction. The real question is, what does a smart investor actually do with this information? What smart investors do instead? Derek didn't buy PennantPark. He closed the tab, took a breath, and built something real instead. He didn't pick one stock, he built a blend. Realty Income for the anchor, the one that's never missed a payment in 55 years, Main Street Capital for quality, the BDC that survived everything, Capital Southwest for income, the highest credit quality with 99% first-line debt, and a small slice of Saratoga, only as much as he's willing to lose if the cushion cracks. 0 PennantPark. On $100,000 blended across those 4, Derek lands somewhere around $600 to $700 a month. That's not the full rent, not yet, but it's real, it's sustainable, and every year the dividends grow, that number moves up. Now let me give you 3 rules that protect this income over time. Rule number 1, put BDCs in the right account. BDC dividends are taxed as ordinary income, your full tax rate, no special deduction. Realty Income gets a 20% pass-through deduction because it's a REIT. BDCs don't get that. So if you own Main Street or Capital Southwest or Saratoga, hold them in a Roth IRA or a traditional IRA. That shelters the income from taxes. In a Roth, the dividends are tax-free forever. Rule number 2. Benchmark against risk-free alternatives. A high-yield savings account pays about $342 a month on $100,000 right now. A 10-year treasury pays about $379 a month. FDIC insured, government-backed, 0 chance of losing your principal. Any stock that doesn't clearly beat those numbers, after you account for the risk, isn't worth the volatility. Rule number 3. Know when to sell. If a stock's earnings fall below its dividend for 2 straight quarters, if the book value drops quarter after quarter, if the payout ratio crosses 100% and keeps climbing, those are your exit signals. They're exactly the signals PennantPark flashed before every single cut, and most investors ignored them because the yield still looked good on screen. Here's the honest math. To cover $2,000 a month in rent from a sustainable blend yielding about 7%, you need roughly $340,000 invested. That's the real target. Not a single stock, not a shortcut, a portfolio, built one contribution at a time. Derek starts with $100,000, gets about $667 a month, not the whole rent, but in 2 years, with reinvested dividends and new contributions, he's at $180,000, then $250,000. The rent number gets closer every year. He didn't chase the shortcut, he built the real thing. The goal isn't to find the stock that pays your rent tomorrow, it's to build the portfolio that pays your rent forever. If you know someone who's chasing high yields right now, maybe they found a stock that looks too good to pass up, share this video with them before they learn this lesson the expensive way. Which of these 5 stocks would you actually put your money into? Drop your pick in the comments. I read every single one. If you're building income that actually lasts, not income that just looks good on a screen, subscribe to this channel. Every video here protects your money first and grows it second. And if you want to see how to turn $25 a week into serious monthly income using a strategy most people overlook, that video is on screen right now.